Hey everyone, and welcome. Today, we are absolutely going to crack the code on a topic that, let's be real, gives a lot of accounting students a major headache: debt investments. We're going to laser focus on the two big ones you need to know for your exams: FVOCI, or fair value through other comprehensive income, and FVPL, fair value through profit or loss. So you ready? Let's dive in. Okay, so picture this. Your company just shelled out 1,000,000 pesos for a bond. Awesome, it's on the books. But now what? I mean, really, what's the next step? That's the million peso question, right? Especially when you're thinking about your exams. This thing is going to earn interest, its value is going to fluctuate. So what's the actual game plan here? Believe it or not, this whole complicated sounding thing really just boils down to two core questions. That's it. First, we ask the why. Why did you buy this thing? What's your company's strategy, its business model? And second, we ask the what. What kind of bond are we actually dealing with? What are its cash flow characteristics? You get the answers to these two, and I promise you, you've pretty much mastered this topic. All right, let's start with that first question, the why. This is all about the business model. And just to be clear, this has nothing to do with how you feel about the bond. It's all about the company's official, documented strategy for this asset. It all comes down to intent. So your company's strategy is going to fall into one of two main buckets for our purposes today. First up is collect and sell. You can think of this as the flexible approach. The plan is to hang on to it, collect those sweet interest payments, but also you're totally open to selling it if the price is right. This strategy points us straight towards FVOCI. Then you have the trading model. Here, you're basically acting like a day trader. The whole point is to buy low, sell high, and make a quick profit on price swings. This model, and pretty much any other strategy that isn't specifically hold to collect or collect and sell, gets dumped into the FVPL category. And listen, this isn't just a helpful tip I made up. This comes directly from the accounting standards. The rules are super clear. You don't get to just pick whichever classification you feel like. Your decision has to be based on these two tests. It's a strict, rule-based process. No wiggle room. Okay, on to question number 2. We figured out the why, so now we need to look at the what. The actual nature of the bond itself. And this is where accountants bring out a fancy acronym, the SPPI test. SPPI. It sounds way more complicated than it is. It stands for solely payments of principal and interest. All it's really asking is this just a plain vanilla, boring old bond? Do the payments you're going to get consist only of the principal you lent out plus standard interest on that principal? If the bond has some weird exotic feature like, say, payments that are tied to the price of coffee beans or a tech company's stock, then boom, it fails the SPPI test. It's not a basic bond anymore. All right, we have our answers. We know our business model, and we know if our bond is a simple SPI bond. So now we just have to follow the decision tree to our final destination, the correct accounting classification. So how do you land on the FVOCI path? Well, it's a super strict two-part requirement. First things first, your business model has to be collect and sell. If it is, that's checkmark number 1. And for the second part, the bond itself, it absolutely positively has to pass that SPPI test. Remember, that means it's just a basic bond making normal principal and interest payments. That's checkmark number 2. And if you can check both of those boxes, and only if you can check both, then the accounting standard says you must classify that investment as FVOCI. See, it's not a choice. It's the mandatory result of your two tests. So what happens if you don't meet both of those strict conditions? What if your model is trading? Or what if you've got one of those weird bonds with non-SPPI cash flows? Well, in pretty much every other situation, it gets classified by default as fair value through profit or loss. FVPL is kind of the catch-all category. Okay, we've nailed the classification, but now we get to the really important stuff, especially for your exams. What does this classification actually mean for your journal entries? How is the day-to-day accounting different between FVOCI and FVPL? This is where the points are won or lost. This table right here, this is your new best friend, your ultimate study guide. Let's walk through it. First up, initial measurement. For FVOCI, you add any transaction costs right into the investment's value. But for FVPL, nope. You expense those costs immediately. Why? Well, because you bought it for short-term trading, so those costs are just part of doing business this period. Now, amortization. You'll notice we only do this for FVOCI. With FVPL, you don't bother. The logic is simple. An FVPL asset's value is just whatever the market says it is today, so who cares about amortizing a premium? Now for the main event, the big kahuna. fair value changes. For FVOCI, those unrealized gains and losses go to other comprehensive income, or OCI, which is a separate little corner of equity. But for FVPL, they smack your income statement directly. And finally, what about when you sell? FVOCI has this special move called recycling, where all those gains and losses you stored up in OCI finally get moved over to profit or loss. With FVPL, there's nothing to recycle because everything already hit your P&L along the way. Let's make this real for a second. You're working through a problem, you're crunching the numbers, and you get this, 20,562 pesos. So what on earth is that? That, my friends, is the magic of FVOCI in action. That 20,562 is the unrealized gain. It's the difference between the bond's shiny new fair value and what its amortized cost was at the end of the year. And because it's an FVOCI investment, this gain doesn't even touch your net income. It gets parked in OCI, just kind of waiting on the sidelines in your equity section. It's pretty clever, right? It lets you show the real economic gain without messing with your company's operating profit for the year. All right, let's switch gears. It is time for some rapid-fire review tips. These are designed to stick in your brain all the way to the LC pay. These are the high-yield facts you absolutely cannot forget. Let's hit it. LICPA pro tip number 1. For FVPL, transaction costs are the enemy. You expense them right away. Do not capitalize them. Just think, short-term trading means short-term costs. Expensing them is a cost of doing business in that period. Nail this down, and you're grabbing easy points on exam day. Pro tip number 2. Recycling is an exclusive club, and for debt securities, only FVOCI gets an invite. Think of OCI as this temporary holding pen for your unrealized gains and losses. The moment you sell that bond, you open the gate, and everything that was held in there gets recycled or reclassified straight into your profit or loss. And pro tip number 3 is a massive time saver. If you see a problem and it says the bond is FVPL, do not, I repeat, do not start making an amortization schedule. It's a trap, seriously. The carrying value is just its current fair value on that specific date, end of story. Don't waste precious exam time on it. So there you have it. You've totally nailed how to classify and account for these investments from day one. But here's a little something to think about. What happens if a company changes its mind? What if they change their business model and suddenly need to reclassify an investment? Well, that's the next level, and definitely a topic for another time. For now, you have the core tools to crush FVOCI and FVPL. Thanks for tuning in.